Today is my birthday. Yep, happy birthday to me. And hopefully all going well. I'll get to have another spin around the sun and all the adventures, all the joys, all the grief, all the craziness, all the boredom, all of the funkiness, all of the fun, all the eroticism, all of the play, all of the laughter, all of the tears that come from a life fully lived will hopefully be mine to explore. And I also hope that a lot of that will be with many of you in this format, connecting through the extraordinary access of the internet and live streams and Zoom calls. And certainly what I am feeling drawn to for the next year is a lot more in-person contact. I'm just setting that desire out there. I'm not sure what that's going to look like. But that is my hope and dream and wish, and more play and love and contribution. And that was a little beep from one of my cameras at my bush place. So let me put that on silence. And I hope more time in the bush and just loving being the wonder of wildlife and animals. So thinking of years ahead, well, let's do a little session on what we might expect in 2023 on the markets and how it might impact our wealth journey and what we should do about it. So now, right up front, I want to say, predictions are as useless as a bicycle is to a fish. Really? But they're a bit fun. And, I've been doing a little bit of research, going around, looking at some different forecasts and predictions in different newsletters and looking at what are the things that some different formats are saying. And it really is such a good thing to remember that the range of forecasts is just enormous. In fact, I think one of the biggest sort of ranges we've seen for a long time. And so this is really important to remember, that even the supposed experts, the BNP Paribas and the Fund Stats and S&P 500 and the Economist, who all spend their time and day looking at all the economy and making predictions of what's going to happen, really don't know what it looks like. And just I was looking at some of the ranges, and just in terms of forecasting what's going to happen in the S&P 500. And the S&P 500 is seen as a really powerful barometer of the market. You might say, and why am I talking about the US market? What about Europe or Australasia or the emerging markets? The reality is the US is the biggest market. It's the most liquid stock exchanges. It's got more companies listed on those stock markets. And pretty much everything else follows those markets. Yes, of course, you'll have regional variations, which we look into, why we divide our index tracker investing into subsections. But broadly, when we're looking at what's going on, when we see what's happening in those large indexes, the S&P 500, the Russell 2000, the NASDAQ, we can pretty much guarantee that the rest of the world markets will follow in pretty similar patterns. So when you look at forecasts for the S&P 500 for 2023, I mean, the difference is, some saying, hey, right up, it's going to go back up to where we were, almost the height of the end of 2021, January 2022. Others are saying the trend's going to continue down. And the range of the forecast is, I think, what is very interesting, whether it's Bloomberg, JP Morgan, is that they are just so spread, showing that there's huge uncertainty. So one theme I think is going to continue through the whole of 2023 is continued uncertainty of just not knowing about what is really going to come along. And what happens with uncertainty, you get volatility. Volatility is when the markets move up and down, prices move up and down. Volatility is also tracked by something called the VIX index, VIX. And the VIX, the higher the VIX, the more the volatility is. So when we can expect unsettled markets, when we can expect volatility up and down, then we can go, oh, okay, it just is what it is. Remember, As wealth creators, as wealth chefs in the making, we understand that we build these assets to serve us for a long time. We don't get the jitters from short-term ups and downs. It's just the vibrations of the market. We know that the longer-term trend is what we're far more interested in. But with volatility does come opportunities. And certainly with high volatility, one of the areas that benefits from that is doing options, writing options contracts, both writing puts and calls. So if that is something you want to look at adding on top of an already established portfolio that you have, this is really not for when you're just starting out. This is when you've got a reasonable size capital mass and you're wanting to get more income from that. How do you squeeze out some additional returns? You can look at options. There is a masterclass on options, and I'm still trying to convince Nick. He's convinced, we just don't find the time from his side to share with you one of the specific option strategies he's doing, where he's writing puts on the shares that he wants to be owning as a buying strategy, especially on the going down. So expect continued uncertainty. And with this is saying, okay, what can we control? We can't control the uncertainty of the markets. We can't control the directions they go. We can't control what governments do. We can't control what's happening in the climate. What we can control is our consistency and our costs and our contributions, those 3 C's. So it's yet another year of remembering, follow your strategy. Choose a simple, diversified portfolio of index trackers and be consistent. Regular investing every fortnight, every month is imperative, especially when there's volatility. Do not try and time the market. Having this consistent time when you buy your units in low-cost index trackers, that's how you control the costs. So consistency, costs, low-cost index trackers, cut out any unnecessary costs, those financial advisors, expensive platform fees. You do not need those. Those destroy your returns. And then the final one are your contributions. Make sure you don't let the uncertainty of what's happening in the economies, in the world markets, make you sit on the sideline. You need to be contributing in. Your net worth has to start with you. You need that seed of money so that assets can grow. So consistency, costs, and contribution are the things you can control, not the uncertainty of the markets. So I wanted to go through 6 big trends that some of the predictions are bringing out in the next, of what may or may not happen in the next year. Now, again, big alarm warning. This is fun to do. It's fun to think what might happen in the year ahead, but please, we should not be chopping and changing our strategy to what may or may not happen, because we just don't know. And that's where people can make big mistakes, lose lots of money. But there are trends that might guide us for our bigger way of relating to the world with our wealth, how we spend our money, which is really important to understand. Because remember, our wealth is created by not just our assets, it's the quality of our income, it's the quality of our expenses. Are we getting value from where you allow your money to flow out of your life? And is it aligned to what you really want? Reducing your consumer debt and liabilities and only having expansion debt in that drawer. And then quality assets. So one of the things that's been on a lot of people's minds is inflation. And this really tells us, the price of the level of goods and services. And we saw in 2022 a year of massive inflation going up, a large of it a result of just money being pumped into the markets in the US and the UK, just printing of money, and this inflationary impact of that. And so we saw this consumer price index, the CPI, just rose up. And in the US, I think it hit something like 40-year highs. And it hadn't been that high in over 40 years. And so what you see as the typical response to higher inflation is the Federal Reserves, the Exchequer, your Reserve Bank in every country who tries to control the economies and the currency started increasing interest rates to try and dampen that down. So in the US, I think the inflation peaked at 9.1, sort of halfway through the year. Then you saw interest rates going up, you saw prices going up, and then you start seeing the inflation starting to come down. Now, a large amount of this inflation was that money printing, but it was then exacerbated by had to do with the cost of fossil fuels. We had had a period of 30, 40, 50 years of massive economic expansion of cheap fossil fuels available and input into every aspect of our lives, food and electronics and transportation. They all need fuel in one form or another. And these energy markets really took strain, predominantly due to the war between Russia and Ukraine. And this really impacted the European markets significantly. And one of the biggest ones was Germany, where this huge increased cost, mostly in natural gas, had a massive impact on their competitiveness, being able to produce materials. And so nearly half of their fossil fuels that they've been using for their industry came from Russia. And with that cut off, the German industry is having a massive, massive strain. And so you're seeing that economy taking strain. So you're going to see Europe continuing to be under strain with this. And many, many industries are having to temporarily shut down production because they just literally cannot afford the cost of production. It's no longer economically viable. And so this has a trickle-on effect of the availability of goods. And then when those energy prices surge, almost everything follows because of transportation, heating. And so I think the forecasts are generally that inflation will start dampening and it will continue to come down in 2023. But if we continue to see these high fossil fuel prices and that pressure on fossil fuels, I think we can expect in 2024 inflation to continue up, and that we are highly likely going to be going into a longer period of inflation. Pretty much what we saw in the 70s through to the 80s, where you had these different peaks of inflation coming up and down. So I think we can see a period of a little bit cooling off, but don't think inflation is just, oh, well, that's gone and we're going to go back to these low inflation and low interest rate periods that we saw basically through all of the 2000s and essentially to date. So what does this mean? Is really be aware of your spending. Be a wealthy spender. Don't be diligent about getting value for the money that flows out of your life. Eliminate unnecessary expenses that come just because you feel you should have them to fit in, those unconscious things. It is so worth our while always to just spend a little bit of time every now and then, do a spring clean of your expenses. Go and see what regular outgoings have snuck in, those subscriptions, those debit orders that maybe you've forgotten about. Are you getting value from those? Where have you just maybe got a bit of sloppy from getting value? Your fixed costs that you've got from including your energy provider to your insurances, go and get new quotes. Be discerning and eliminate those unnecessary expenses in your insurances. Really, get rid of unnecessary add-ons and understand you want to be buying the core. So this is really key. Our wealth is actually created by how the money flows through our life, the cost of our outgoing. Because the cost, if your lifestyle cost is significantly higher, you need a much bigger amount of assets in order to pay for that lifestyle in order to be financially free. So if we can really get clear on what brings us joy, what lights us up, what do I really want, and then make sure that our spending aligns to that, this is how you get wealthier much faster. So make sure you really choose to be a wealthy spender this year. Now, the US dollar. This is also a huge, big currency. A lot of different currencies are pegged to the dollar or linked with it and has an impact on that. And we also saw in 2023 this really up and down. The dollar rose massively and it rallied and it really strengthened towards the end of 2022. And but again, pretty volatile and up and down. We also saw huge collapse of the British pound with the political uncertainty and that little bit of mayhem that happened in the UK. Eek, that was awkward. And so these different currencies moving relative to each other. Now, when you're holding your investments in those base currencies, it's important to say, well, are you going to have some stability or strength in those currencies? So most forecasts is that the dollar is going to continue to be relatively stable. And but is going to have a little bit of a downtrend. It's had a very, very strong upward move, and these in quick succession. And so I think we can expect a horizontal stabilization of the dollar and possibly even a small weakening. Does it make any difference really in your investing? No, but with inflation, with the dollar, especially when you're investing in, say, in emerging markets where you want to be holding your investments in those bigger developed market currencies, you might want to look at spreading some of your investments, say, between US dollars and euro. Pound, hard to know where it's going to go. We need to see some political stability and economic stability coming out of the UK. Whereas the pound's always been a very, very strong currency, but essentially the euro has got more stability now. So interest rates, so linked with inflationary pressures. And the last 2 years, we've seen this massive rise in interest rates, where we're seeing essentially a downward trend from the 90s going down to interest rates were almost at zero. Effectively, money was free for a whole period. So there's a whole generation that doesn't really know what it means to have higher interest rates. But we've seen this massive rise as Treasury, as the Fed has tried to respond to inflationary pressure and that massive sort of multi-trillion-dollar spending that came about through COVID. And and also just increasing debt. So we just see this continued pressure on government-based debt, and the national debt in the US is enormous, and it's up more than 10%. So it's crazy. It's just sitting at, it's almost doubles every 8 years. So we have this crazy situation of essentially most of our governments being bankrupt with these huge outstanding debts, and that also impacts interest rates. So even with estimates of inflation stabilizing, most forecasts expect interest rates to continue to move up a little bit higher in 2023. So for fixed interest asset classes, great. So you can expect to see your yields increase on treasury notes, on certificate deposits. That's your fixed deposits, on your yields, your coupon yields on fixed income side. But be aware that if you're taking on a lot of debt, whether it's even if it's expansion debt, make sure you've got the flexibility. You do your cover when you're looking at property investing and you're taking on those loans. Make sure you've got that interest cover. It's called interest cover. How much could that interest rate go up, and you would still be okay with the cash flows and the yields of that particular asset. If you're taking on debt in business, if you're taking on, and if you think very carefully about overstretching yourself in neutral debt for, say, the home that you live in. Remember, your home is not an asset, and so you always want to keep that really controlled. You don't want to put yourself at risk, and where you can, lock in a fixed interest rate, which just gives you some certainty about what those costs are going to be. So gold is always often is considered something that zigs when everything else zags. It often is seen to move counter when there's a lot of uncertainty. It's perceived that gold goes up. Now, it's interesting, gold hasn't performed quite like many people expected it to in the past, in the huge uncertainty of 2023. I think because there's also just craziness in the crypto world and Bitcoin, which had started becoming another form of a chaos hedge. So, the first half of 2023 looked good for gold, and then the dollar really rallied, and money moved away from gold into the dollars, because gold isn't really an asset of any form. It's a preserver of value. It just sits, but it doesn't grow in value. It can't do new things. Its value can't increase. Its price can increase, but not the value that it produces. And it doesn't produce any income. There's no interest on it. So when interest rates rise, often gold is seen to be less attractive because actually it's reducing. And so it's also India and China are the world's biggest gold buyers, and there was a lot of uncertainty in the Chinese market. So you saw quite a flat year for gold. It it finished basically on zero. It didn't go anywhere in 2022, despite that huge volatility and the uncertainty. So where it's going to go, really hard to tell again. But generally, looking at the different macro pictures, it's certainly considered to continue to be a preserver of value. So stabilizing the portfolio. I don't think it's going to do any big upside or downside trends. So you can continue to decide to have some of your portfolio in it just to, if you want some stability in that, and there might be a small gold price increase, but I'm not expecting anything to shoot the lights out. But again, these are just predictions, and it can all, go completely in the other way. Oil, fossil fuels. So most of the predictions is that crude oil prices will continue to go higher, and we did see that happen in 2022, and we saw some spikes, and with these key oil-producing nations like Russia and Saudi Arabia having problems, there's an issue. So what's going to continue in 2023 is really hard to know. And this continued instability in Europe, war, the impact on fossil fuels is really hard to know. But there is a sense that the Chinese economy is reopening. It's starting to move again after such a shutdown with COVID from 2020 onwards. Even with this latest big round of COVID restrictions, they are starting to reopen. So I think we're going to see more economic activity there. And so depending on how that goes, this could light more of a fire again under the demand for oil. And so we've got war, now more demand as more of the economies start coming up. And I think we can expect the price of oil to go up in 2023 and continue to be pressure. And then also on the oil gases, really around, depending what happens with wars. And then the stock market. So the big US market, which is the big sort of focus where all most other markets follow. The S&P finished 19% down in 2022, and that can be like a big eek. But it's also to say, hey, you can buy great companies cheaper. So remember, when we do consistent regular investing, we benefit from the downturns as much as the upturns. We do not sit on the sideline. If you're a net wealth creator, it's a great buying time. If you're just starting, hell yes, this is so great. If you've got if you're close to your freedom number and you're going, oh shit, and my net worth is contracted about X amount, remember that's a paper loss. It's not really a loss. We're just seeing these ups and downs. When you've got a structured drawdown plan, where you know that how you're feeding off those assets, the bulk of your investments, it's going to come back. It shifts and turns. So it's really, again, hard to know what is going to happen in 2023. Many forecasts are saying they're expecting that with inflation stabilizing, even with higher inflation expected to stay, but with some stabilizing, not this crazy rise, with interest rates going up, that they expect that the stock market will turn in 2023 and start trending upwards again. Now, when, I don't know. What we can do is absolutely expect volatility. So be consistent. Don't try and time the down top. Don't try and time the bottom. Just say, hey, we don't know, but what we can do is stay consistent with our strategy, our regular, consistent, wax on, wax off, boring is beautiful strategy. For those of you who don't know what I'm doing with my wax on, wax off, I'm giving away my age from the original Karate Kid, which was all about stick with the fundamentals. So real estate, investment property, physical bricks and mortar. 2022, it hit higher, and it really did. And certain markets, this was really fueled by shifts in people's ability to work in different places. So you saw in the residential markets, crazy shifts in prices that really threw things up. Commercial property, office, retail having a tough time, but looking at reinventing itself and shifting around. So now as the interest rates started going higher, it started impacting developments, and developments started becoming a little bit riskier. And so we want to see higher returns when that happens. So, I'm just looking at some of my notes. So also, as those mortgage rates start increasing, uh, you start seeing that impacting and pressuring the housing market and impacting the housing supply. As developments slow down, the housing supply comes in, that puts pressure on it. So when mortgage rates are low, when they've been in this historically low period for long, the supply was also at record lows. So it was really difficult for a lot of people to find a home in both the US and most of the developed markets, despite these low interest rates. And now we're seeing this trend shifting, and with the rising mortgage rates, it's becoming even less affordable. So rental markets are still a really good place to have, providing family apartments, multiple developments. Really, people that goal of home ownership is still going to continue to elude them. But as an investor, if you're a provider of housing and homes, make sure you really understand your numbers, understand the pressure on inflation is going to have on fuel costs. You're going to see rising interest rates. So I think the actual price of, you know, the housing stock of real estate, it is so location dependent. So you cannot do just a global around the world. But generally, it's expected to see that it's going to continue to be flatten out. And in some of those areas where there's been these peaks, that will come off a bit. And with increased and higher mortgage rates, you'll see a dampening of the price as it becomes more of as there's fewer buyers around who can afford, so a pressure on prices coming down. Now, the world of crypto, hey, that was a crazy, wild world where the crypto really saw the domain of greed coming into the world. And you saw collapse of many of these centralized crypto exchanges who got into the whole lending and leverage world, and greed absolutely made them do stupid, bloody things where they started lending on stuff they didn't have, and essentially mirroring the credit crisis that happened in the real estate market in 2008. It happened in the crypto market. And this is really the tragic element. Humans and the lure of greed, of just more, more, more. How can we get more? Not understanding that life and sustainability sits on that beautiful line of enough, blew up the crypto markets for many people. Now, I do not believe crypto is dead. I think the blockchain and the blockchain technology is extraordinary, will continue to revolutionize the world. But the impact of that greed and corruption, basically, that with FTX, CoinDesk, and many of those exchanges has really, it scared a lot of people. It also, I think there was a lot of knee jerk on the regulatory side of where wanting to throw the baby out with the bathwater. When we saw the credit crisis in 2008 and where there were unscrupulous lenders had really put pressure on the market, many of those were bailed out by governments, and a few companies were left to go. We didn't suddenly say, oh, well, housing should be banned. You should never be able to have mortgages or lending. You shouldn't have financial institutions. Well, maybe we should have banned a whole bunch of those because, quite frankly, they just rip off most people. So, I think the FTX debacle has really impacted and significantly dented the trust of the crypto ecosystem. And so I think it's going to take years to build this up. So we can expect to see lower and continued really flat Bitcoin prices, and then that impacts the other areas as well. So the key thing is, if you've got big lumps of money, if you've got any side, do not now go and, if the main message is be consistent, be confidently cautious. You should never just be leaping around in any parts. Remember to stick with your investment pyramid. Your boring is beautiful, consistent investing in mature asset classes. Get your index trackers going. If you've got a lump sum, you're going to tranche it in over a period of months, expecting volatility. Real estate, you want good quality stock in sectors where there is demand. Again, you want to spread your exposure. It's better to have a number of smaller units than one big, fancy, expensive one going up. You're more speculative. investments like your cryptos, your collectibles, your private equity, expect volatility, keep small position sizes, do not put any big lumps in there. We are still in a bear market in pretty much all of the markets, and especially in crypto. I think we're going to be turning out of the bear in 2023, but we are in a bear market and stock market. So the key thing, which should always be the message in anything when it comes to do with our wealth, is just don't be stupid. Have a plan, have a strategy, stick with it. Do not let your emotions hook you, either the mountains of fear or greed. Stay consistent and know that at the end of the day, we actually don't know what's going to come along. So we rest in the humility of being human. We don't know, but we can create an ecosystem. We can have a portfolio. The way we manage our money can be in such a way that it gives us resilience and able to respond to different things. And this is how we live a wealthy life. We don't lurch from trying to get the greatest return and what's going to be the next thing. We go, we don't know. But what we do know is we are leaders to our money. We have a plan. We stick with it. We know that consistency wins over and over. And that is how we have another fantastic, wonderful year around the sun, celebrating the fact that we get to be alive and have this amazing life, and we have money supporting and serving us to live that. Hell yeah, let's do this thing.